Just barely about an hour and a half ago, President Muhammadu Buhari began the presentation of the 2022 budget estimate of 16.39 trillion naira to a joint session of the National Assembly. The budget presented fixed the price of oil at $57 and also looking at 1.88 million barrels of oil per day and an exchange rate of 410 naira 15 kobo. A breakdown of the budget further shows that federal government's total expenditure for the coming year is projected to increase by 2.47 trillion naira from 13.98 trillion naira to now 16.45 trillion naira, and this also includes government-owned enterprises, that's GOEs, and project-tied loans. Joining me now to discuss this and much more virtually, I have the head of retail investment at Chapel Hill Denham, Ayodeji Ebo. Good to have you on the show this afternoon.
Good afternoon, and thanks for having me.
Well, one of the highlights of today's presentation is the fact that we've seen a commitment by government and also the National Assembly to ensure that we have and we still sustain efforts at consolidating a January to December budgetary cycle. How commendable would you say this is?
I think it's very commendable to be consistent with the January to December budget since it has been started, and I feel that this should be applauded, and it's really very commendable. Like we have stated, it's positive in terms of outlook from the foreign investors or from other clients looking at or sustaining this particular trend.
Let's also look at the fact that we are seeing this budget size of 16.39 trillion naira. We're looking at expected revenue to be generated at 10.13 trillion naira. We have debt service of 3.61 trillion naira, and we also have a deficit of 6.2 trillion naira. In following the money now, our growing debt level is quite worrisome, but according to the speech of the president, it says that, well, we are still within safe threshold. What does that really mean by going by these alarming figures we have on ground at this point in time?
Okay, thanks. I'll start with before each year we try to come up with a budget, and based on the trend we've seen on a year-on-year basis, you see that growth in terms of expenditure growing significantly faster than the revenue. And if you want to know how the budget will perform, if you look at past performances, it also tells you a bit of what to expect. So based on the speech, which I got shortly before this interview for the presentation, you would discover that based on the July performance that was stated, you would discover that the revenue that they were able to achieve was still like 34% below the expectation, which is about 2.6 trillion that was able to the government was able to achieve out of the 3.95 trillion that was, if you look at it, prorated within that period. So if you look at the expectation, if you project that, looking at the expenditure even for that period, that they've spent about 6.7 trillion naira so far in the first 7 months, and you try to annualize that, and that is expected to they continue at that spending rate about 11.4 trillion naira, and the revenue, if you also annualize that, will be about 4.4 trillion naira. That's leaving a deficit of about 7 trillion. And when you look at this deficit to date, it's you see that it's really alarming. And that will continue to blow up the debt servicing. You have mentioned that based on the submitted budget or proposed budget, you would the deficit is around about 3-point-something trillion. Most times when you see the actual deficits, you would see that it's always significantly higher than what is being projected. Pardon me, I think it's about 6 trillion based on the projection. But we will discover that it's also going to increase more than that. And that will continue to increase the debt servicing. When you look at debt servicing to actual revenue, you would discover that we may be seeing something at over 100% in the next year, and that is really very concerning and reduces the chance of trying to fund the capital expenditure. And to just wrap up on your question, in terms of the ratio, so most time we focus on ratios as a proportion of GDP, but we need to tell ourselves the truth. Our GDP is not productive. So when you look at in terms of revenue that we derive relative to the size of our GDP, in terms of actual revenue, you would say that you agree with me that it's not productive, and we need to do a lot to flood our GDP and extract value from it before we can say we are comparing to GDP. You know, for instance, expenditure to GDP may be around maybe 30%, and it looks like, oh, it's at a very comfortable level. But we know that this GDP can't generate the revenue that will be able to pay for our expenditure. So I would like to just leave it there for now.
Little bit reaching a little too far now in terms of the president's speech, making mention of targets in the medium term, looking at revenue to GDP growth ratio now from about currently 8% to 15% by the year 2025. That's a target that is quite a big gap to fill, literally, and still holding on tightly to these words as I read out now. We don't have debt sustainability problem, rather there's a revenue challenge to check debt in a sustainable range. Looking at such statements now versus our debt levels and looking at the recurrent expenditure that we have on ground as well, we are still adopting the same pattern of ratio that limits our growth trajectory. Isn't this clear?
Yes, I think it's really very clear, and we can see that this is unsustainable. So we've always been saying on a yearly basis that we have a revenue challenge. So what if we have not been able to address that problem such that our revenue can grow faster than the expenditure? So when you look at the year-on-year growth based on the budget for expenditure and the revenue, you will discover that expenditure is still growing like twice faster than the ratio, the rate at which the revenue is growing, which we know meeting it is always a challenge, and it's really very obvious. If we see Nigeria as a company, if you're having challenge in terms of growing your top line, which is your revenue, then you need to do something about your costs. That is the reality. We need to be sincere with ourselves to look at, for now, if we cannot grow our top line, then you need to reduce your expenditure. Focus should be more on capital expenditure, which is where the other 95% of Nigerians benefit from. When you look at personnel costs, which would account for over maybe about 30% of the total expenditure, the number of people that spend the personnel cost, or would say the cost of running the government, cost of providing policies, is significantly higher than what we spend on the capital expenditure. So we need to be realistic, and we need to do something about that.
Okay, now putting things in clear perspective of realistic approaches, we have a statutory transfer peg of 768 billion naira thereabout, loan debt recurrent cost of 6.8 trillion naira, personnel cost at 4.1 trillion naira, pensions, gratuity, retirees benefits 577 billion naira, and overhead costs 792.3 billion naira. And juxtaposing that now to the strategies of revenue mobilization that the president has made mention of, enhancing tax and excise revenue to policy reforms and tax administration measures, boosting customs revenues through e-customs and single window initiatives, and also safeguard revenue from oil and gas sectors. At this point in time, borrowings are necessary. The president has also said he prides himself in the fact that we are also seeing improvement in infrastructure from power to rail to road and all of those. But are these visible enough to say that this is what the translated volume of our borrowings actually reaches? Do you think we have enough at hand to say all of the borrowings equate to substantial infrastructural development that we can hold on to and then propel the economy by?
I think the figures can speak for themselves. Based on what has been released so far, if I can get the number correctly, about 1.7 trillion has been released so far based on the 2021 budget for capital expenditure. So when you look at it and you also look at the deficits or the borrowings, you discover that most of the borrowings have been going into recurrent expenditure. I would say there's been a lot of initiative around trying to fix our infrastructure problem, but the pace at which we are going, the gap is very significant. So there needs to be deliberate more effort. I'll put it that way. Then we need to intensify effort on attracting private investment. So I would just cite one or two examples. So like the tax structure that you use your tax credits to build roads, we can see that benefit. So that we should be able to encourage more of that. The Sukuk bond structure is also an interesting structure that limits leakages. So I feel that that's the approach that we should adopt more to build our infrastructure. The infra code that has been set up will also go a very long way to help. So we need to continue to intensify efforts around some of these strategies to be able to bridge that gap. It's been estimated that close to about maybe 3 or 4 trillion naira will be required annually to fix our infrastructure gap. So there's a lot that needs to be done about that. But the reality now is most of the borrowing still goes into recurrent expenditure. So when you check debt service as a proportion of actual revenue, you will discover that based on the data, I think it's about 95 or 98%. So if we're assuming that, and this is debt servicing, it's not about paying down the debt. So we feel that there needs to be a new structure, a new model, or
a new structure model.
To be able to
Now, let's also take a further breakdown of the reports that we've had so far as the president presented. We're looking at an exchange rate of 410 naira, 15 kobo to the dollar, inflation rate of 13%, and also a projected GDP growth rate of 4.2%. Starting off again once more, looking at the GDP growth rate that we're looking at for next year. The World Bank shared some thoughts on Nigeria's GDP growth rate at this point in time. Away from the recession, it says it's still relatively slow. And secondly, looking at our exchange rate now at this point in time, do you see any light at the end of the tunnel, seeing the Naira bounce back? The government and the CBN has been quite careful of the terms Naira devaluation, irrespective of what has been playing out. We've also seen the policy by the Central Bank of Nigeria in terms of forex allocation. And since the broader exchange operators have had their licenses suspended and funds not going to them, we've also seen quite a spike. Do you think we can have a strong production base that will push the Naira stronger and even better allocation measures? Do you see that playing out?
Okay, thanks. Very interesting question. I think to address the issue regarding our Naira, we all know the solution is to diversify our export proceeds so that we don't get into a very tight corner anytime we have a significant drop in oil prices. So as long as we have not solved that problem, or we are not even trying to solve that problem, then the crisis, CBN will always be in a very tight corner, trying to solve this problem, because there's a limit to also what they can do once oil prices are really down. Yes, this year we've seen proceeds on Eurobonds, we've seen inflows from the IMF, but it's not going to be recurring. If we don't get that next year, what happens? And we've seen the FPI also dip significantly. So it's really a tough time. And speaking to the assumptions, currently the official window, which is the NAFEX rate, I think closed around 413 naira to $1 yesterday. And when you also check the 6-month forward rate based on FMDQ data or 12 months, you'll see it's around maybe 430, 440 naira to a dollar. So, which is a signal that there may be an adjustment within that period, speaking to the forward rates. So, I would say that it's really a very tough time, and we need, if we don't solve the problem of the export proceed, our dollar proceed, if we don't diversify it, this issue of FX will continue to linger, and is really going to tell a lot in terms of prices of goods will continue to increase, which will impact on consumer wallets.
And what do you also make of the oil price benchmark as well of $57 per barrel, and also production base of at least 1.88 million barrels per day? The COVID-19 is still there. Largely, the global economy is looking at ways of maneuvering through. Hence, we've seen oil price rally. But this has not necessarily translated in how robust our external reserves are, because we continue to dip our pockets deep in there to have certain augments done and then adjustments and then cushioning. But at this point in time, pegging it at $57 per barrel when we are trading well about $80, in the case of any other shock, do you think we have enough of cushions?
Yes, I would say that the $57 barrel is quite conservative, and given the current situation, and also looking at the OPEC Plus stance to at least continue to control production. So you would see that the average rate, average production within the period was, I think, about $1.7 million per barrel, including condensates. But there's a limit to which our production will need to, we don't have control, but that's where I'll put it, regarding the production. Though we expect that the global economy opens up, we should be able to see an adjustment in terms of the production. So, but by and large, would expect, I feel that it's really conservative, but because of the OPEC quota, what we are getting in terms of oil proceeds, looking at even the actual performance, it's like was down by about, underperformed. I would say it underperformed by about 50%. I think total proceeds up to July was around 591 billion naira, which is trailing, which will underperform by about 50%. So oil, yes, we can see where the part of the FX price is coming from. Proceeds from that has dropped significantly. So we need to look inwards and see what we can do to increase that by increasing our export. What can we add value to? We look inwards, and we can also be able to export, while we also look at reducing imports.
Ayodeji, we are gradually wrapping up our conversation at this point in time, but as part of the plans that we're expecting from the government, from the president, the executive, and then also the National Assembly, we're looking at the annual budget to also be accompanied by the finance bill, looking at the realization of fiscal projections, the current tax and fiscal laws to produce the finance bill 2022. There are ongoing consultations which are expected to be completed before the end of this year, and according to the President of the Senate as well, we would also see an intense scrutiny of all of these estimates. But what sort of incentives do you think you'd like to see in the Finance Bill 2022 to spur up this projections we have? Because it's in as much as it's conservative, it's still a big feat to achieve. What sort of incentives do you hope to see in the next finance bill? Incentives to propel businesses, incentives to ensure that we have more economic stability, incentives and also tax reforms that would redefine our course of economic growth away from the regular model or approaches or records we've had in the last few years.
Thank you. I would like to at least first comment that now that we, on a yearly basis, will try to make amendments around the finance bill. And so the expected finance bill for 2021, which part of the incentive I would expecting government to introduce, it should be focused on the SMEs. They are the major driver of this economy, and they should find a way to devise incentive for most of the SMEs based on their categories, so that we can have more of them coming on board in terms of registration. So if you are registering, even if you are not started paying, there should be an incentive that you get. And some of the intervention funds that we see that we have been seeing so far can also be tied for you to be able to get or have access to these intervention funds. You must have at least fulfill some obligations around your registration for tax. So more for me, I'll be expecting to see more focus around incentive for the SMEs, so that we can see more of them can grow and they can employ more.
And just before I let you go, it will be a major disservice if I don't ask you this question. Looking at the state of insecurity in the country and also the shocks that we've had from the COVID-19, these two are double-edged swords that we have to still manage through. How do you see these also redefining how we might likely meet up with all of these fiscal projections we have? How do you see things turning out to be in your best and worst case scenarios?
Okay, thanks. I think the elephant in the room is insecurity, which impacts across the different sectors. So agric is a major contributor to GDP, and with the challenges we're having with insecurity, even which is mostly around the food producing area, would impact on production, and as a result of that, would impact on prices. And insecurity also cuts across distribution, and that is a major concern that we need to look at. If we don't resolve that problem, it would impact and limit our growth. Foreign direct investors, even domestic direct investors, will be reluctant to spend or to invest in the country if insecurity is not tackled. So I believe that on a scenario basis, our performance will be based on how we're able to tame insecurity in the country, which would have a major role, a major determinant on how the economy will grow in 2022.
Thank you very much for your time on the show this afternoon. It's been a pleasure speaking with you, Ayodeji Ebo. We've been speaking with the head of retail investment at Chapel Hill Denham. Ayodeji, good afternoon.